loan is less than $10,000, then no tax update. Capital gains only come into play if it is a capital asset. One Bitcoin is worth $39,984.70 in US dollars. Ask Roger. Hey guys, I'm Roger Herring. I'm the Investor's Accountant, and thank you for coming by our YouTube channel. Before you leave today, be sure you hit subscribe and click the bell. That way you won't miss any of our free educational videos. Hey guys, I'm Roger Herring. I am the Investor's Accountant. Welcome to my office. This is where it all happens. Now, as promised with the last video, we're going to talk about the king today. Nope, not Elvis. We're talking about depreciation. Now, why is depreciation the king of all deductions? Because we can use specific tactics and create great big upfront losses using depreciation. Now, whether you can deduct them or not depends on how we do it and what your status is. Are you a business owner? Are you a real estate pro? Whatever. So all I'm going to do today is discuss depreciation tactics, not whether or not you can write it off. So as always, this is educational purposes only. Seek professional advice before you do anything. All right, so let's talk about depreciation. What is it? Well, what we're doing is when we buy an asset, we're going to recover the basis over time. And sometimes it's a 3, 5, 7, or 15-year recovery period. If it's a rental property, if it's residential, it's a 27.5-year recovery period. If it's a commercial property, it's 39. So these tactics really come into play to create upfront losses so you don't have to wait 27 or 39 years to write stuff off. Okay, now here's another wonderful thing. Because this is recovery of basis, it's non-cash. So the underwriter is not going to get upset with you if you use depreciation, because all he's going to do is say, okay, you made $100,000 according to this. You have $140,000 in depreciation, so you really made $240,000 profit. That's the way it works. You're happy, the underwriter's happy, everybody wins except the IRS, and that's the way we want it. So let's talk about basic strategies. The first strategy I'm going to teach you today is actually how to convert something to be from depreciation to be repair and maintenance. Now, why would we want to do that? Well, if we convert it to repair and maintenance, we can write it off right now. And when we sell that item, we do not have to have a depreciation recapture. That's right. When we sell something that we have depreciated, the IRS is going to recapture that depreciation. So how do you get around that? Well, usually you don't unless you scrap the item. Okay, now if you totally depreciate, say, a computer and then you sold the computer, whatever you got for that computer is going to get taxed as ordinary income. There are different recapture rates for different types of property, but we're not going to talk about all that today. We're just going to talk about depreciation. Now, some people say, well, hey, Raj, if I have to have it recaptured, why don't I just not depreciate it? Well, the law says that you have to recapture depreciation claimed or that you could have claimed. So that's kind of heads they win, tails you lose. So always take depreciation. Always, always, always. Now then, back to this strategy. It's called the de minimis election. And what de minimis allows us to do is to take anything that has a total cost of $2,500 or less and write it off immediately. So, if I buy a computer for $1,400, I can write it off immediately under the de minimis exemption. If I put in countertops into a rental property and they cost $2,455, I can write them off immediately, and when I sell the house, that's not part of my recapture. Pretty cool, huh? And here's the thing, because it's repair and maintenance, the state's going to let you write it off. Most states don't accept bonus depreciation. So you get to write this off for federal purposes and for state purposes, but here's the bad part. The underwriter doesn't like it because he sees that as real expense, not depreciation. So you got to be careful with what you do. Now, The next strategy that we have is called Section 179. Now, if you are in an operating business, an ordinary income business, let's say you're flipping properties, you're wholesaling properties, you're a realtor, you're a construction company, you have an ordinary income stream, you can use Section 179. You can buy an asset up to a value of a couple $1,000,000 and write it off immediately, as long as you have that much profit. You see, Section 179 can't take you below zero. So if you've got $100,000 worth of profit and buy a $200,000 piece of equipment, you can use Section 179. You can bring your income for the year to zero and not pay any taxes. You still have the cash flow that's come in, and you've got a carryover. The other $100,000 will be carried forward until you can use it. Pretty cool, huh? Now, landlords, you're not an operating business. You are a passive income business. You don't get to use Section 179. But there is something out there right now that everybody can use. It's called bonus depreciation. Now, what does that mean? That means if I go out and I buy something, as long as it has a life of less than 20 years, I can write off 80% of it immediately in 2023. Now, that was 100% between 2018 and 2022. But now we're starting to phase out the bonus depreciation allowance. This year, it's 80%. Now, I got to caution you. While Section 179 and de minimis are recognized at both federal and state level, bonus depreciation is usually only recognized at federal level. So you're going to get a huge federal write-off if you use bonus depreciation, but you're still going to have to depreciate over time for state purposes. Not too bad, because most of the time the federal tax rate is a heck of a lot higher than the state tax rate. Okay, now let's get a little more advanced. People always want to know about two things: the SUV deduction and cost segregation. All right, SUV deduction. The item has to be greater than 6,000 pounds. Okay, 6,000 pounds is where we're going. And what we can do is we can write 80% of the purchase price off, okay, in 2023. Now, that's subject to a couple of other rules. You see, let's say that you went out and you bought a Silverado pickup truck that weighs 6,700 pounds. It qualifies, but you only use it 50% of the time in business. That means your maximum write-off is 50% of the purchase price times 80%. That's right. Everything is subject to the business use of the item, and I do not recommend anything that is going to be used 70% or less. Okay, 70% or less, I would probably use the mileage deduction, because mileage is forever. And hey, whatever my trade-in allowance when I get rid of the vehicle, guess what? It's going to get taxed as ordinary income. Yeah. So look at it as an interest-free loan from Uncle Sam. All right? Now, cost segregation. Well, what the heck is that? Cost segregation is a method of applying an engineering study to a building. And we pull out the components of the building, such as windows, doors, land improvements, cabinets, carpets, all the things that are not part of the house or the building that have a shorter depreciation period. And what do? We class them into 5, 7, and 15-year items. And because they are life less than 20 years, we can write off 80% of that value right now. Now, between 2018 and 2022, that number was 100%. Well, Raj, I bought a building in 2020. I didn't cost seg it. What can I do? You can cost seg it now. And you get the law that was in place when you bought the property in 2020. That's right. Now, I've had clients that have bought $400,000 properties and been able to write off $140,000 immediately. Okay? Now, that doesn't happen all the time. It all depends on the land value and the structure, okay? That's why there's an engineering study that has to be done. And you can do those studies with an online company from anywhere from $500 to $1,500, so it is very economical now to utilize cost segregation even for residential properties. Now, what else could we use this for? I love cost segregation strategies because it allows me to move money to where I can actually accumulate more wealth tax-free. Here's my example. Let's say that I want to convert $50,000 in a traditional IRA to Roth. Why would I want to do that? Because Roth never is going to be taxed again. It grows tax-free, I take it out tax-free. So, what do? We go ahead, we do the conversion. Now I've got $50,000 worth of income. And we do the cost segregation, and the cost segregation produces a $50,000 loss. I now match that income to the loss, and it nets to zero. Now, there are very particular rules for doing this. And you've got to make sure that you can actually take that loss, because if it was on a rental property, you've got to be a real estate pro, and I address that in other sections. If it's a building that your S corporation utilizes for your own use, you might be able to do it without being a real estate pro. All right, so once again, education only. Make sure you talk to a competent tax professional before you do anything, okay? Now, I already alluded to this nasty thing called recapture. Recapture is a fact of life. So for anytime you have molasses, you're going to have some sulfur with it. And recapture is the sulfur. So if you do a cost segregation, anything that you cost segregated out and pulled out and accelerated the depreciation on, guess what, guys? That's going to be recaptured when you sell as ordinary income. And if you tried to do a like-kind exchange, a Section 1031 exchange, you would have to leave out the portion that was cost set. Now, there are ways around that as well. So once again, discuss this with a competent professional before you do anything, and let them explain all of the ins and outs, the good, the bad, and the ugly. In fact, if you go back and look in my page here, you will find information on cost segregation. You'll find information on Real Estate Pro. And in fact, I think the video is called Cost Segregation, the Good, the Bad, and the Ugly. Look it up. It's been great being with you guys. I look forward to the next time. Until then, Roger out.